What do you make of oil prices? That's something that's been really perplexing me. I've spoken to a lot of economists about it. The amount of oil coming out of the Strait of Hormuz is still about a third of what it was before the war. Yet futures prices are down to pre-war levels when the strategic reserves are still low and there's still that massive shortage that the market is the market needs really. It needs the oil that was coming in before the war to get back to the status quo. There hasn't been that massive demand destruction that is needed to maintain low prices when supply is restricted. And that's not even considering the risk premium that should be taken into consideration about the risk of the war restarting or Iran closing the Strait of Hormuz again. So putting all these pieces together, how are oil prices so low?
Well, I think to look at that. By the way, just back to the MOU, the word that was going through my mind but not coming out of my lips was, it was really a surrender.
Mm.
The
A
U.S.
surrender
signed.
document, yeah.
Yeah. So that's that. Now let's go to the oil prices. The oil prices. Understand what's going on. You have to look at the forward curve. That is the spot or current market for current delivery versus the price at some future point in time. And what happened after the war started, the oil market and the diesel market and gasoline market, all the derivative products went into what they call a extreme steep backwardation. That's when the spot price for current delivery is way above the price for some future delivery point, whether it be the end of this year or end of next year or what have you. So that's the thing that happened. Now this is fairly unusual because if you look at the last 20 years of data, the crude market, the Brent market, has only been in backwardation about 5% of the time. Now, what normally, I'm setting up the economics, kind of the principles of what's going on here. Normally, it's in what's called contango or a carry market, where the spot market is a lower price than the future market, and that is for Brent 95% of the time. That's the way it is. So it flipped from contango. Basically, it was kind of flat right before it wasn't contango, it wasn't backwardation, it was basically flat. So the war starts, it goes into this huge backwardation. And the best way to understand the shape of the forward curve, it gives you basically it's a loan market. So if a market is in backwardation, that means that inventories are very scarce and people are trying to borrow from the future and resupply short inventories. That's when things are in backwardation. Normally it's in contango. It's adequate inventories, everything is fine, positive carry and so forth. So now what's happened, it hasn't completely flipped, by the way. I just looked at this, the Friday markets. It hasn't completely flipped into contango. So in fact, it hasn't flipped into contango. The oil market's still in backwardation. If you look at Friday's spot market, Brent was 72.13. The 1 year out, it was more or less flat, 72.37. And then if we go to December 2027, it's 70.34. So it's basically kind of flat now. And that compares, by the way, to April 7th, 2026. The spot was 111, and the 2 year December 2027 was at 75. So it's a huge difference. Now, what you get into, and you've interviewed Jeff Curry about this. He's on top of the thing, and so the oil market's kind of flat. It's gone from backwardation to flat. The gasoline and diesel, that's not the case. There's still considerable shortage in inventory showing up if you read the curve properly. And the curve now for gasoline spot 295, forward one at the end of this year, 227. So the spot market price is a little higher than the futures market for the end of the year in December. And diesel, you end up with the same thing. The spot price is 326, and the December 2006 is 299. So that means there's still quite a bit of tightness in these product markets.
On the refined product side.
On the refined products. Now, this is a point that Curry's made in interviews you've had with Curry. Of course, he's one of the real experts on this kind of stuff. So we've had this kind of temporary increase in the flow, kind of, shall we say, unanticipated increase in the flow coming out of the Gulf as things loosen up a little bit. And they're only loosening up at a trickle, I would say. It's not a flood coming out of there.
Exactly,
some more is coming out than was coming out before. And as a result of that, you've had the immediate spot inventory starting to fill up, and that backwardation has come out of the curve and it's settled down. That's not the case with these refined products, by the way. The refineries are going full blast, and we still have shortages in inventories of gasoline and diesel, as well as all the other refined products, by the way.
Is that because of the issues in Russia, as well as the logistical issues with all that oil stuck in the Gulf and coming out slowly at a trickle and not going to the right refinery to be refined? Is that why the refined products?
Yes, that's the Russian thing comes into the picture, because the Ukrainians have been denting the refining capacity and damaging it in Russia, and the refined products have dried up. The ones coming out of Russia. I mean, Russia's into rationing for gasoline and diesel fuel, and importing some of those refined products. So that's why we have this situation for the refined products. Now, going forward, what do I anticipate that the markets don't seem to be anticipating, and that is that the people are going to find out that, well, we actually are short of inventory. What about all the crude that was drained out? We're at all-time lows in inventories, but that isn't showing up in the market today.
Exactly. That's the weird part.
The market would be normally, I think the market should be in backwardation for Brent, and it isn't. It's flat.
Where the spot price is higher than the futures price.
Yes, spot prices should still be higher than the futures price, in my view.
Because of the shortages, because of the shortage of oil for the refineries as well. So not enough is coming out of the Strait of Hormuz.
Well, it's mainly, my argument would be that the inventories are at all-time lows. And normally, by the way, all you have to do is look at a forward curve with the spot and futures prices, and you know whether you've got adequate inventories. If you do, the spot price will be lower than the futures price. You'll have a carry trade, a carry market, a so-called contango. If you have a shortage, however, and inventories are low, you're always in backwardation. Heavy backwardation, where the spot price is above the futures price, and people are actually borrowing from the future to put product into inventory.
Yeah.
And they're paying a price for it, with the spot price, of course, being above the futures price. That's normally what happens. So this is very abnormal, by the way. And all this was worked out, by the way, in 1930 by Holbrook Working. He was the big expert who got into the relationship for the first time between the forward curves and inventories. And what we know from that work and the work going forward is that when inventories, when inventories are inadequate, when you see a backwardation in the forward curve. But we're not seeing that right now. but we know inventories are at very low levels. So it's kind of anomalous what we're seeing right now.
It is bizarre. It is. Like, I don't know why traders are just expecting not only the war to have ended, but oil to just flow out of the Strait of Hormuz at the same numbers as it did before the war. But that's just not happening. Today, in the last 24 hours, only 39 ships in total went through the straits, about a third of what it would be, even less than a third of what it was before the war. So reality is just so disconnected from what the markets are telling us. It's just weird for everybody, and different people have different explanations.
Yeah, I have no explanation except to say that we know this is anomalous, and we can go back to all this academic and as well as industry studies that have been done relating the forward curve to inventories, and if inventories are low, which they are now, we know that's something we know. You find the price structure should be one in which you observe spot prices above futures prices by a considerable level. They are a little bit now, but not very much. But they should be really quite, you should be seeing quite a bit of backwardation in there for Brent, and you're not.